Hello and welcome to the first part of the lecture for Chapter 12. I'll post the second part, the remainder of Chapter 12, on Wednesday. So in this section here, well, the chapter overall deals with inventory and the related category of cost of goods sold. It's a very important category for every merchandising or manufacturing business, so it requires a lot of attention and a lot of preparation in terms of what the audit staff will do. So in the lecture today, I'll cover the nature of inventory and the cost of goods sold. I'll talk about what the auditor's objectives are regarding inventory and cost of goods sold, what they're most concerned about, what they hope to accomplish from their audit. And then I'll talk about documents, records, and accounts involved in the production cycle. In the next lecture, I'll talk about understanding the client and their environment. I'll talk about internal controls for the production cycle, and then I'll talk about specific tested controls and substantive procedures. So what does inventory include? So inventory would include goods on hand that are ready for sale, meaning they're completely done, packaged, and ready to ship to a customer. Could also call those finished goods. We'll talk about, or they would include rather, goods in the process of production. So that's something that in our cost accounting classes we call work in process. So any product that is production has started, but it's not complete, meaning ready to sell to a customer or ship to a customer, that would be included in work in process. And lastly, we would consider all raw materials, purchase parts, and supplies. So those would be three separate categories for all manufacturing companies. We'd also want to take into account the lower of cost or market. I'll talk about that later. So the importance of auditing inventory. So it's an area where management can be tempted to overstate the inventory. So if you remember the way that inventories affect the income statement, if inventories are overstated, that means cost of goods sold is going to be understated. If cost of goods sold is understated, then gross profit is overstated, and then net income is overstated. So that's something to obviously be concerned about. Any company that wants to inflate their net income, a lot of times they'll get involved in some shenanigans with regard to inventory. Are they creating inventory that isn't really there, or overvaluing the inventory that they have? Let's see what else on here. So we want to make sure that we determine the quantities of inventory. Sometimes that requires specialized techniques. A friend of mine did an audit of an oil company. So he had to go in those huge containers that house oil and figure out how to do the geometry to figure out how much oil was there and that sort of thing. So counting another company's inventory can sometimes be more challenging than just counting parts on a shelf. And inventory represents, in many cases, the largest current asset of a company. So it's very important from that perspective as well. One thing to think about here are companies that do periodic inventory versus companies that do perpetual. So companies that do periodic inventory, then hands down, there has to be a full count that's audited at the end of the year. Companies that do a perpetual inventory, so they're keeping track using their ERP system every time they purchase a component or transfer a component or ship a component, they're adjusting their inventory levels. So companies that have that type of system, that have a strong set of internal controls that are followed religiously, so they have a good, well-functioning perpetual system, that may allow for test counts to be done at other times of the year, which can be helpful in doing an audit. So the objectives of a production cycle audit: one is to obtain an understanding of the client and its environment, to consider inherent risks. So that's the nature and complexity of the production cycle, the likelihood of inventory being stolen, kind of the nature of what the inventory components are, and just how the company goes about producing product. Secondly, we'd want to obtain an understanding of internal control over inventory. I'll talk about that in detail later in this lecture. And then we want to assess the risk of material misstatement and then design our tests according to that, that likelihood. So some of the objectives specifically, and we've seen this list before, but now we'll talk about it from the perspective of inventory. So the first thing that we'd want to know is, does the inventory that they claim exists really exist? And like I mentioned before, in terms of manipulation of financial results, that would be really our paramount concern, is are they reporting inventory that isn't really there? The way we would do that is we would go from the inventory count to the floor. So we would say, you say there's 150 of these widgets, now go find the 150 widgets, that sort of thing. We also want to make sure that we can substantiate the occurrence of transactions that affect cost of goods sold. So were costs really incurred from a labor perspective or manufacturing overhead perspective that would justify the existence of inventory. Then we want to establish the completeness of recorded inventory. Here I would look at, so here we're worried about inventory being understated, which again is less of a concern, but still a concern. So in that case, I would want to look specifically at, did everything get counted? Of course, are there racks or areas in the factory that weren't checked? And then secondly, I'd want to take a look at what is the status of inventory in transit, either purchases that were purchased FOB shipping point that are en route to the company, but not on hand when inventory is taken. I'd also want to look at outbound shipments of product that were shipped FOB destination, so still belong to the company even though they're in transit. The other thing I would look at is, does the company have any consignment of their own inventory at other locations? So have they moved part of their product to a supplier to be worked on, or to a retailer to sell, that sort of thing. We'd look at the cutoff of transactions, so receiving transactions, and we'll talk about that more in the next lecture, and shipping transactions, make sure all of that activity has stopped while inventory is being taken. We want to make sure the client has rights to the inventory, so have they been pledged primarily would be the case as collateral for a loan. We'd want to establish that the inventory was valued properly, so getting into their cost accounting system, getting an understanding of how it is that they value inventories, make sure that's of course in accordance with generally accepted accounting principles. Some methods that companies use, like activity-based costing, are not acceptable for GAAP, so have they made some conversion or correction of cost on that account if they use an ABC system? And again, looking at lower of cost or market there, have they done an analysis of what the replacement cost and the net realizable value is of each component, and compare that to what their cost is to make adjustments if necessary. Then we'd want to determine if the presentation and disclosure is accurate. So are they showing the proper levels of inventory in terms of breaking down the classification of raw material, work in process, and finished goods? Do they accurately describe what accounting methods they use, that sort of thing? So some internal controls, I want to first talk about the control environment within the company. So is management committed to having competent people throughout their production and system? So do they have competent receiving staff, competent purchasing staff, competent warehouse staff, production staff, and so forth? So people that are able to identify components and do their jobs properly. Have all of the people that have been assigned to take the inventory, and often it involves people outside of the production area to get the inventory done. I'll show you an example of some inventory instructions in the next lecture where you can see we have people from throughout our company taking inventory. So have those people been trained properly so that they know how to take the inventory correctly? If they don't take the inventory correctly, of course, they introduce errors into the system. Next, we'd look at integrity and ethical values. So what are the policies the company has with regard to the relationship between purchasing agents and suppliers, as an example? The text here uses the term kickback. Another term you could look at is gratuities. So are purchasing agents allowed to accept tickets to the Seahawks game from a supplier? Those sorts of things. That can lead to people within the company making decisions that are not always in the company's best interest with regard to how they deal with those outsiders. What's the organizational structure and the assignment of authority? So do the proper people in the company have authority and responsibility over areas that they should? Making sure that the purchasing, receiving, and production personnel all understand their roles and don't kind of stray out of their lanes in some respect. Next, we look at risk assessment. So what is management doing? And these are more risks that relate to the overall viability and sustainability of a company. So what has management done with regard to ensuring future availability of supply of goods, services, or skilled labor? So are they covering that potential risk with alternate sources of supply, backup sources of labor, that sort of thing? What about the stability of prices and labor rates? Do they fluctuate wildly, or is it a relatively stable environment? Does the company do cash flow planning to ensure that they have cash flow to pay for future purchases of product to ensure smooth production? What kind of changes in technology have they undertaken with regard to the manufacturing process? And then what are their policies about obsolete inventory? Do they have a policy for writing it down after so much time and destroying it, or whatever the case may be? Next, monitoring. So you'd want to do observations, or rather production supervisors need to observe performance of different activities and functions. The next, quality and performance reviews. Do they have a formal system for documenting the fact that their quality is what they purport it to be? The word performance review here, again, we've touched on this in a couple of other lectures. Performance review means comparing actual results to what they forecasted or budgeted the results would be and investigating the differences. So making inquiries about whether the company has a system like that. A standard cost system would be a great example of generating variances and then researching those variances to find out is something going wrong or what the situation might be. And then a formal program to consider improvements by the internal auditors. So I next want to talk for the next couple of slides about who does what with regard to a production environment. And we'd be looking at internal controls that ensure that each of these functions are doing the following things. So the receiving department, that's really where it starts, is where raw materials come to the business. So their first function is determining the quantity of goods received. This is best done on a blind basis. So if they don't have access to the purchase order from the purchasing department, they would need to count the goods and determine indeed there are 102 goods here or 100 or 99 or whatever the case may be, without being able to kind of cheat by looking at what the purchase order says should be there. So it helps to guarantee an honest count. Next, they would look to see if any of the goods have been damaged or if they're defective in any way, so that would require some inspection. They'd prepare a receiving report saying what goods came in on what day and what the condition of them were. And then they would promptly move those goods to the stores department. Stores is another word for warehouse, so you could think of it as a warehousing responsibility. So when the warehouse receives those goods, they'll count and inspect them as well and indicate that they've received them. That's a double check on what the receiving department does. So that's a good step there. They'll notify accounting of the receipt of the goods. So accounting can match that receiving report with the purchase order to start a voucher for when that bill will finally be paid. And then they physically secure the inventory. So they make sure it's in a locked space, that only people have access to it that need access to it. The production department will file a requisition, which would be pre-numbered, saying I have a particular job or production task that I have to do that requires raw materials. They would submit that to the warehouse department. The warehouse department would take those goods and move them out of the warehouse and into the production area. They would report that to accounting, so accounting can record that transfer of product from one area to another area, really from raw materials to work in process. Again, those are pre-numbered so that you can keep a log of which ones have been issued and look for gaps and that sort of thing. It's important to keep in mind that all production activities are controlled by a master production schedule. That master production schedule starts with orders from customers or forecasted orders from customers, and it takes that information together with inventory policies. So how much inventory do we want to have of different components at different stages? It could be 0 or it could be some higher number than that. And that will determine what actually needs to be produced in the factory. So we may have received an order that, looking at the inventory policy, causes us to do a larger production run, so we build inventory up, or maybe a smaller production run, so we consume some existing inventory. That's what that will tell us. Again, the company's ERP, or Enterprise Resource Planning System, will help tell us that. So that system will issue production orders. Production orders are information that's given to the factory that tells them, take these 12-foot 2x6s and cut them into 3-foot pieces and drill 4 holes in each one, or whatever the case is. But it tells them specifically what to do with what inventory. So we'll use material requisitions and move tickets to move things from one department to another, again recording that information in the accounting system. And then we'll also use job time tickets to keep track of labor usage throughout production. Once production is complete, then we have finished goods on the shelf. Then the shipping department takes over. So they'll ship only upon authorized sales orders that come to them that have been approved by the credit department. That should jump out at you as some documentation that would be really important to check to make sure things aren't leaving the facility without that verification that the customer isn't on credit hold or something like that. So when they ship a product, they'll generate a pre-numbered shipping document, again pre-numbered, so we can keep a log of all of them and know what has left the building. We can use that to verify that everything that has shipped has been invoiced, as an example. So one copy of that shipping document will stay in the shipping department as a record of what they did. A second copy will go to the billing department to trigger the customer being invoiced. A third copy will accompany the product as a packing slip, which helps the customer identify what they've received. And then the fourth copy would be used as a bill of lading if it's shipped with a common carrier, meaning a trucking company. So that's the end of this lecture. I'll start, the next lecture will be available on Wednesday, and I'll cover the remainder of the chapter and show you some documents from my company the last time we did inventory. So thank you very much, and please, again, don't hesitate to email or give me a call if you have any questions. Thank you.